day, everyone. Thank you for joining us once again here at Seafried and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to review over the fourth quarter GDP, the third estimate that came out last week, and then look at some inflationary numbers pertaining to PCE and also some inventory and the durable goods release. So if we look at the third estimate for GDP in the fourth quarter of 2017, came in at 2.9%, not quite where we were in the third quarter at 3.2, but it is up from where we for the first estimates came out. And we can see that looking at the advanced second and third releases, where in the second release we came in at 2.5, just under the advanced release at 2.6. So we pop up here in the third release at that 2.9 by 40 basis points. But when we're looking at the contribution from a consumer, we can see that jumped up from 2.58 to 2.75. So we had a pretty nifty increase there, and that came in terms of services more so than goods. And particularly transportation services really picked up in the consumer segment. When we're looking at that investment segment, the business investment, we can see that's up to 0.78, up from where it was at 0.59 in that second release. And the majority of this increase is due to inventories, adjustments in those inventories, where previously we had a much larger decline in inventories. That was adjusted in the third quarter to show, while a decline, still less of a decline. And that took up or contributed most of the improvement in that inventories number or that investment number. Exports, imports, very, very similar release to release, and as well as the government spending. So overall, when we look at the fourth quarter numbers and the difference in the different releases, it's the consumer and the investment segment, primarily services and inventories, that have made big changes when we look between the different releases. All that said, we want to see where the inflation numbers came in, and for the core PCE, we can see it picked up just a little bit. We're up to 1.6% year over year. In February, that was above that consensus of 1.5 that was out there. So we saw a little bit of an uptick. However, we still are well below that 2% target for the Fed. When we're looking at the differences between the goods prices versus services, we can see that in February, the goods prices actually came down by 0.1% month over month, whereas the services prices went up 0.3%. So we have that disparity between the two, and then working out to that 0.2% month over month change. That is similar to the year over year changes, where we had the goods up just 0.1% and the services up 2.5 percentage points year over year. So there's changes in prices coming in primarily through those inventory or those services sectors. Looking at inventories, though, we can see a positive here for retail and wholesale continuing to build inventories. We saw positive movements in January and then now in February on both the retail and the wholesale. That should be a positive indication for the first quarter 2018 GDP in terms of the inventory changes. And then also we had a positive impact in the durable goods inventories, up 0.4%. Looking at the durable goods release, we can see new orders came in much higher than consensus, 3.1% month over month compared to 1.7% for the consensus. That's a pretty strong number there. However, we have to take into consideration that the prior month came down 3.5%. So I want to continue to see positive movements and not these volatility that we've been seeing. But overall, when we look at transportation, up 1.2%, double what the consensus was at 0.6. And then also we look at the prior at negative 0.2. Similar with the capital goods and the shipments, both increases this month. And then we have the unfilled orders at 0.2, up from its prior of negative 0.3. So we continue to see that change there. And hopefully, as we move into March for the durable goods, we should see the similar movements, positive progression here, which would bode well for the first quarter GDP number. But we still have a number of indicators to come out to give us a pretty firm indication as far as where that GDP number will be in the first quarter. And that's what we have for you this week. Have a great week, everyone.